Hi guys, we're going to review for the intermediate exam for a little bit. So let's go through the review sheet and make sure that there's everything that you need to know on here. A few things to point out. The exam does not include chapter 17, which is the pension chapter. That's the one that I gave you guys a given sheet for, so it's just not on there. And so we will not have any questions over that chapter. But chapter 10 feels like so long ago, so you really need to take some time and review stuff, okay? So what I've got here is just the review sheet pulled up along with the Excel review pulled up as well. So I just kind of want to work through some questions and make sure we understand everything you need to know. So for chapter 10, there is one problem that is a journal entry for an exchange. And so what you can expect from that is something like, let me see here. So I'm just kind of looking to see all the different tabs. I have one for double declining, straight line, chapter 11, chapter 18, chapter 19, chapter 19. Okay, so let me go ahead and just create another tab in this. Let me get out of that one and let me go in the one that's editable. That one. All right, so let's go ahead and I'm looking to see, okay, double declining, some of the year's digits. Why is that on there? It's weird. Chapter 11 problem, 18, 19, 19. Okay, so I will just do one here for chapter 10 problem. And this one, it states that it is a journal entry for an exchange. So a journal entry for an exchange has some key components to it. We would identify what we're giving up and what we're receiving, and then if it has commercial substance. So what you would look for is, keep in mind that if a transaction has commercial substance, you do record a gain or loss. If a transaction lacks commercial substance, you do, I don't know where the comma goes. I have no idea. You do not record any gain or loss. So let's say we give up equipment with a book value of 100,000 and 10,000 cash for new equipment that is worth, I have no idea, 135,000. The equipment we are giving up had a cost of 140,000 and accumulated depreciation of 40,000. The exchange has commercial substance. So I just totally made up that problem. I have no idea how it's worded on the exam. I'm just saying, like, this is a potential scenario. So we are giving up equipment with a book value of 100. That's where this 140 and accumulated of 40 is coming from. And so book value, remember, is cost minus accumulated. I may or may not tell you the book value. I may just tell you the cost and the accumulated. So you need the cost and the accumulated to be able to do the journal entry to record it. And I think the question says journal entry for an exchange. So it will depend on if it has commercial substance or it lacks commercial substance. But in this case, what we would do is we would record the fact that we are giving up. We gave up cash. So on the fourth line, I'm giving up cash of 10. And then we would show the equipment leaving the building. And the equipment's cost is 140. The accumulated depreciation is 40. We'll have equipment coming in called new. Now, in this situation, we are going to record a gain or loss, but if it lacked commercial substance, you would not. So the amount of the gain loss is found by comparing book value to fair value. So book value in this problem was 100,000. Fair value was 135. So the equipment that we are giving up is worth 100. Let's see. I don't think I worded it right. The new okay, so let's see. Let's say we give up equipment with a book value of 100 and 10,000 cash. And then how about I say the original equipment had a fair value up. I think that's the way that it's worded, of 135. And so the equipment we're giving up had a cost of 140, accumulated a 40. Okay. So book value and fair value means that the books say it's worth 100, but it's actually worth 135. And so that is a gain of 35. And so then I have a total of 185 here. So I would do 145 there. So my total credits, I added them together and they were 185. And so I need 185 there. The other situation we could look at here is if the equipment, or if it lacked commercial substance. And remember what lacked commercial substance means. It means that there is no, like the exchange isn't a real exchange. So maybe it's a related party exchange or something like that. And so if I were to exchange equipment with my brother, it's not a real transaction because either of us could manipulate it. So in this one, I could say that it, like, instead of has, I could say lacks. And then all we would do is we would delete out the gain because there would be no gain. And then equipment new is the plug. So then here I have 150. So here I would do 110 to make the journal entry work. So, okay. So that's a solid review from chapter 10. And then as far as multiple choice goes, it just says costs that are capitalized for an asset purchase. And I would say all costs to get the asset to you and ready for its intended use. So that would be like if you had to pay shipping to get the equipment to you, or if you had to install it, or you had to build a platform for the equipment to sit on, or change the outlets, or testing. All those things are part of the cost of the asset. And then basket purchases, as was the other topic mentioned. And I think that's something you guys just know about, but it's when you buy a group of assets and do the percent of the total thing. So you know how to do that. Okay, so chapter 10 was so long ago. Chapter 3, one problem. It says computations and journal entries, depreciation and book value and sale. Like problem 11.6, but just straight line, 10 points. No idea what all is included in that. And so I'm just kind of reading through this and I'm trying to give you like a review without like giving you all the questions. But we need to know how to do the depreciation and book value and sale, straight line. So let's use, first I want to make sure I didn't have anything else attached here. Yeah, I was wondering if I was going to use something like this. Okay, so there is a problem attached at the end that would kind of help you do this, but first I'm going to look at chapter 11 problem example. Yeah. So here is a solid one. And so this is going to be like the problem that's on the exam. And so if I were to do one of these from scratch, then what, let me go ahead and just delete what's here and do the whole thing. So it says we purchased an asset on March 1 of 2014 for 60,000, useful life 5 years, no residual values, straight line. We sell the asset on November 30th, 2017 for 22. What's the book value at the date of the sale, and do the journal entry for the sale. This is a great problem. So, okay, so we're purchasing an asset for 60. So let's do what is the annual depreciation first, and it's straight line. So it would just be cost minus residual divided by years. And so cost is 60,000 minus 0 divided by 5 years. So in that situation, 60 over 5, 60,000 divided by 5 is 12,000 each year. But so in 2014, so for depreciation for 2014, we would do 12,000 times, and so we only owned the asset for March 1 to December 31, so 10/12. So 10,000. For 2015, it would be the full 12,000. For 2016, it would be the full 12,000. And then in 2017, we're going to sell it in November. So we only owned the asset for 11 of the 12 months. Now we learned in the project that you might use like a half year convention or something like that, but we're not going to worry about that. So we're just doing it based on the months times 11/12. So my accumulated depreciation at the date of the sale is 45,000. So accumulated depreciation through sale date is 45,000. So what is the book value at the date of the sale? All we would do is we would say cost minus accumulated depreciation, which would be 60,000 minus 45,000 is 15,000. And then we'll do the journal entry for the sale. So, are you okay, Tor? No, yeah, come here. Okay, so we sell the asset for 22. So I would bring in cash of 22. Can you go just check on Tor? He made a funny sound. He's in the bedroom. I think he's just closer. Oh, okay. So 67 are my debits and 60 are my credits. So it looks like I need a gain of 7. So we show the cash coming in, we eliminate equipment, we eliminate accumulated, and then from there, the gain or loss is a plug. Now we should be able to find the gain or loss. Like we didn't have to do it as a plug because we could do book value versus fair value. And the book value was 15 and the fair value was 22,000 is what we sold it for. So I guess it's not fair value, it's selling price. So the $7,000 gain is identified there. But that's a solid example that you may have to do for the journal entry, the computations and journal entries for depreciation and book value and sale. So for additional topics, it says calculating depreciation using straight line, double declining balance, sum of the years, digits, methods, and finding book value. Consider changes and estimates as well. So this is covering the 3 multiple choice questions. So what I want you to consider, double declining balance and sum of the years digits are here. But as far as other things that relate, basically on any depreciation multiple choice question, the things I might ask you are annual depreciation Okay.
Yeah.
What happened?
What's the-
Oh, okay. Annual depreciation expense, accumulated depreciation at the end of any year, or book value at the end of any year. And then you have to be able to compute that for straight line, double declining balance, some of the year's digits.
Put them in the store, put them in my pocket.
Your socks.
Put them in my pocket so they don't wet.
Oh, that's a good idea. Are your shoes wet on the counter there, bub?
Yeah.
Okay, can you put them on the floor in the bathroom by the vent to see if the air will blow on them?
Actually, I'm gonna go on for a second, just put mud on there.
There's a little bit of mud on the sofa?
Yeah.
Okay, why don't you figure out a way to clean that?
Okay.
Depreciation using those three methods and book value, consider changes and estimates as well. So one of the things that could happen is we could do double declining balance for a while and then switch over to straight line. Again, though, that's going to be in multiple choice. So I think you're going to be fine with that. So, okay, chapter 12, 7 multiple choice, that's a lot. And then one problem doing journal entries for the equity method. So let's do the problems for the journal entry for the equity method first. And so I'll just make a tab, rename chapter 12. And so, chapter 12 problem is journal entries for the equity method. All right, and so it would be purchase, dividends, net income, and I don't think you guys learned about amortization, so I think you're good there. So remember, I'll give you a note at the bottom, but so equity method is for between 20% and 50% ownership when we have significant influence. So if we have less than 20% ownership or no significant influence, we use the cost method, or sometimes we call it the fair value method. Okay, so when we have the equity method, we make the investment in account go up for net income and down for dividends. We do not adjust the investment account to fair value. That's my note down below. Okay, so the purchase entry. My mouse has stopped working. Great time in this semester to make the mouse not work. Investment in, and we can just say Rachel. So investment in Rachel. And then the purchase would be credit to cash. And this is for the purchase price. And then when we get dividends, we'll show cash and we'll credit investment in. And then when we have net income, oops, what's going on? And then when we have net income, we debit investment in and credit income from. So this would be based on our ownership percentage. So if we wanted to give an example, we could say Faith purchases 30% of Rachel company for 120,000. Rachel pays a dividend of 30,000 and has net income of 48,000. And then we say, I don't know what's going on. I wasn't paying attention. The value of what company is 135,000 at year end. What's up, guys? I'm still making videos. That's why I'm like randomly talking to myself. So the purchase was 120. The dividend was 30,000, but we only get 30% of it. And then the net income is 48,000 and we only get 30% of it. And then we do not care what the value is at year end because we do not adjust it to fair value. So yes, Andrew. Yes. All right, so that's the chapter 12 problem, and it's a lot of multiple choice. And so which are adjusted to fair value, which are not, how the adjustment is recorded, current versus non-current, cost versus equity. Okay, so cost versus equity is here. So, so which ones are adjusted and which ones aren't? We have three different kinds of investments. We have trading, available for sale, and held to maturity. Trading adjusts to fair value through unrealized holding gain / loss dash income. Adjust to fair value through unrealized holding gain / loss dash. If you were in class, you'd say it out loud, OCI, and do not adjust to fair value. Record at cost and amortize. So trading securities by definition are ones that we're going to hold for the short term. Available for sale are ones that we plan to hold for the long term or basically long term. Held to maturity are ones that we plan to hold until they mature, meaning they can only be bonds. So this one can only be bonds. Only bonds because stock doesn't mature. Okay. And so let's see if I've answered the questions here. So which ones are short term and long term? So which are adjusted to fair value, which aren't. Okay. How the adjustment is recorded on income statement or part of OCI, current versus non-current. So usually these are always current. These are usually long-term. These are long-term, usually. So the only time a held to maturity would be current is if it's getting ready to mature. And available for sale means you're going to hold it for the long term. So I think it has to be long-term. So cost versus equity is this up here. So remember that we'll use the cost method. So methods of recording investments, cost or equity or consolidate. Those are your choices. So cost is less than 20% or no significant influence. And this is between 20 and 50% with significant influence. This is over 50%. Okay. So, and this is what we do in advanced accounting. So we don't have to worry about that. You just need to know the journal entries for these methods. If you're using the cost method, it'll fall into one of these categories, and that's how you'll do your entries. If you're using the equity method, that's those entries up there. All right. 13 is just multiple choice questions, no problems. So calculating interest on notes, and that's basically using I equals PRT. Advances from customers are considered unearned revenue, and so you put that in a liability account. Which ones? Remember, a contingent liability is one that's probable and reasonably estimated. And so it's just basically going to be, do you record it as a contingent liability or do you disclose? It has to be both probable and reasonably estimated for you to do anything with it. And then warranties are an example of a contingent liability. And so you would estimate what the warranty expense is in the year of the sale, and then you would record it as a liability.
I just put my finger in the water.
Chapter 14, it says 2 problems. So one of them is a journal entry for retirement of bonds. One of them is a selling price of a bond. And so you can go back and watch the video from exercise 1410 to do this. I can do one real quick too. Let me see if there's one on the practice thing. Chapter 11, 18, 19, 19. Okay, so for chapter 14, so 2 problems. One is retiring bonds, which is super easy. When you retire a bond, you just eliminate the bond, the discount or premium, show the money that you paid to retire it, and there will be a gain or loss. So let's retire bonds that have a cost of 500, let's do 600,000 with unamortized discount of 12,000, retire them at, I don't know, 103. Okay, so you will eliminate bonds payable. I'm actually gonna move that. Okay. So eliminate bonds payable that's sitting at 600,000. Eliminate the discount. Discount on bonds payable has a debit balance, and so it looks like we need a credit discount. And we're going to pay cash to eliminate it, and it's at 103. And so it looks like we will have a loss on sale, loss on redemption, loss. I don't care if you write the rest. So if it's a loss, we have 600 here, but here we have a total of 630. So it looks like a $30,000 loss. Okay, so that's the problem on retiring bonds. And then the other problem is selling price of bond with amortization table. That's what it said. Let's go check. Selling price of bonds along with entries for effective interest rate method. You will use Excel. Okay, so let's go ahead and let's issue bonds. Let's issue 500,000 of 7% 10-year bonds that pay interest semi-annually when the market rate is 9%. The bonds, let's see. So no, do the journal entry. So let's say calculate the selling price of the bond, do journal entries for the issuance and the first 2 payments. All right, so when you calculate the selling price of a bond, you have to do the present value of the principal and the present value of the interest payments. And so to calculate the present value of the principal, you use the present value function. And the rate of interest is the market rate. It's semi-annual, so I'll divide it by 2. The number of years times 2. And the future value is negative 500,000. Then for the present value of the interest payments, first I need to calculate the interest payments. So I equals PRT, And so 500,000 times this bond pays 7% interest for half a year. So I would do 500,000 times 0.07 times 0.5, 17.5. So that's the amount of the interest payments. So if I find the present value of the interest payments, I'll use the PV function again. And then we use the market rate. So when we're doing our time value of money calculations, we're always using the market rate. So 0.09 divided by 2, again, 10 years times 2, and it's a payment because it's multiple times, negative 17,500. So the selling price of the bond is those two numbers added together. So it looks like 434, 960, 32. Now this makes sense because the face value is 500 and our answer should be less than 500 because we know it's selling at a discount because we are only paying 7% when the market's paying 9%. So let's build an amortization table for that. And so we would have date, and then we would have, let's see, interest expense, interest payment, amortization, unamortized, and balance, I guess. And so I may not have these in the exact right order, but I think I do. So to start off with, for a beginning balance, we're going to start our table at the 434, 960, 32. And so our unamortized is going to start with the balance in discount on bonds payable, which would be the difference between 500,000 and 434, right? So let's go ahead and let's do the journal entry for the issuance first, just so we have that. So we would only receive cash of 434, 960, 32. And then bonds payable would be credited for 500,000. And so then discount is a debit balance, and the difference would be 65,039.68, which was the number I put there. I just wanted to show it to you. So, okay. And so then we're going to make 20 payments. And so they're going to be every 6 months for 10 years. So I'm just going to number them 1, 2, 3, and just do 20 of them. My mouse doesn't work, so this is proving to be an issue. It only works sometimes. There we go. Okay, so my interest expense is based on the previous balance. And so, and again, use the market rate. So 0.09 times 0.5. My interest payment is 17,500. So the difference is my amortization. And then the amortization will whittle away. Okay. So this number right here, you can find it one of two ways. You could take the 434 and add the 2,073.21, or you can always do 500,000 minus the 62. So this number is going to get bigger and bigger and bigger until it reaches 500,000. If it was a premium, it would get smaller and smaller and smaller until it reaches 500,000. But at the end, we have to reach 500,000. So this number will stay constant. This number, again, based on previous balance. This is the difference. This one's getting whittled away. And then this one is 500,000 minus that. Okay. So I could have also done equals this plus this because I wanted to get closer and closer to 500,000. So if I do this and double click down, everything's fine except for the 17.5 should have stayed constant. When we get down to the bottom, oh, look, I'm off by a penny. Okay, the reason why I'm off by a penny is because I typed in that number right there. Whereas if I would have went like this, that number, and then I would have done this one as this one minus that one. And then this one is equal to that one. I think it'll come out better. Yeah, so now I come out exactly, but it's good. So for my payments, for my 2 interest payments because I needed to do journal entries for the issuance and then the 2 payments. I would do interest expense, cash, and then I'm whittling away the discount. I've got a credit discount. So interest expense, 19.5, discount, 20.73, and cash, 17.5. And then the next one, same accounts. Interest expense, 19.66651, cash, 17.5, discount, 21.6651. So that's it for chapter 14. Let's go back over here. 2 problems. That's it. Good. Okay. Chapter 15, no multiple choice, but all of them are just like filling in blanks in an amortization table or looking at the carrying value of the lease like through it. So go back and review problem 15.3 for that one. Filling in blanks in an amortization table would just be filling them in based on like the payments and the interest and the principal. It's really easy. And I think that if you go back and review 15, you'll see that. There's one problem on chapter 16, and you need to be able to do this. And I would encourage you, let's go back and look real quick. Did I make a video for the review for the exam? I feel like I probably did. Would it be weird if I watched one of my videos while I'm making a video? But like, I remember us working through them. So the one on the exam is almost exactly like chapter 16, probably this one.
All right, I recorded my difference of 4,000 would be a deferred tax liability.
So that one's good. And also E16.6. So both of these are really good to help you prepare for chapter 16's one homework problem. So I would do 6, and then I would also do the 15 because I think that would be a helpful one to review because I think they're both good. So remember the idea. I feel like I need to show you. I just don't want this video to be any longer than it already is. So chapter 16. Keep in mind that we will have financial and taxable, and then you'll have stuff and a difference in depreciation, which will create a difference in pre-tax, like pre-tax accounting income, pre-tax taxable income. So one of these numbers will be given that if the depreciation is given for both. So if this one, and this one are given, then you can find this one, and then tax is a percentage of that number. So if depreciation is the difference and you get 20,000 here and 18 here, then everything else is the same. And so the 20 here will make this number littler than this number. And so you'll go through and you'll do that. Watch the videos. It's very good. Okay. So chapter 17 is none. Chapter 18, one problem, and it's who gets dividends, preferred versus common stock. We did that in class and it was really easy. It was with the arrears. And so go back and review that problem. Topics, basically just basic entries. And so look at the notes to get this stuff. And so what did I put here? Chapter 18 problem, who gets dividends. So this is a good example of it. And you can kind of walk through and say who gets it. And this helps you through that. So other things from 18, like what's par value? It's just an arbitrary number assigned. It tells you how much goes in common stock versus the rest going in PISEP. Calculating total equity. Remember that it's all the money from owners, and then you subtract treasury stock. So journal entries for cash and stock dividends. Cash dividends, you have 3 dates: date of declaration, which is the date it becomes a liability; date of record, which is no entry, but just who gets the money, and the date of payment. And that's when you eliminate the liability and you credit cash. And so for a stock dividend, you give out shares of stock. It's based on the date of declaration is the date that you figure out how much goes in stock versus PISEP or whatever, like the value of the dividend. So, okay. And then chapter 19. Chapter 19 is so heavily tested, you guys. And so you really, really, really need to know how to do earnings per share. And so the two problems are both calculating basic and diluted earnings per share. And so reviewing these homework solutions is so important, but also specifically the one we went through, the very last one we went through on Wednesday, where we went and we had like 2 different items and they were both dilutive, and then you had to combine them. And so the idea is that you will calculate basic, and then when you calculate basic, then you decide if the stuff, if you convert, if everything converts, does it make the number go down? If it makes the number go down, then it is dilutive. And then if you do another one and it makes the stock price go down, then that means that they're both dilutive and you have to combine them. So let's do this. This is one that you can just read through on your own and use it for practice, but let's do another one. And I'll change the numbers and we'll do it. So we have 125,000 common shares outstanding. We have, and I'm just making up these numbers, so if they end up being a pain, that's going to be my fault. We have 1,000 shares, 2,000 shares of convertible cumulative 4% non-participating stock with $100 par value that can be converted into 3 shares of common stock. We have 1 million of 6% convertible bonds, these 1,000 bonds, right? These 1,000 bonds can be converted into 10 shares of stock each. Our net income is 940 and our tax rate is 30%. Okay. So now I'm gonna delete all of this and do it. And so this is just a good sample question about the 2 problems that you're going to do for the exam. So, okay. So currently we have 125,000 common shares outstanding. We have 2 different potentially dilutive securities. We have some convertible stock and we have some convertible bonds. Our net income is here with the tax rate. And then we have basic and diluted earnings per share. So let's go ahead first and let's calculate basic. Basic will be 940,000 minus, it says cumulative non-participating. So I need to know, what should we pay for preferred dividends? So it says 2,000 shares of convertible cumulative 4% non-participating. So convertible means you can convert it into common stock. Cumulative means it does accumulate over the years. And so really what we're looking for is, did we pay preferred dividends or not, or declare preferred dividends or not? But even if we didn't declare them, if they're cumulative, then we have to include them. So it's $100 par times 4% is $4 per share times 2,000 shares. So we should have paid 8,000 in preferred dividends. And then the number of common shares outstanding is 125. So my answer is 932 divided by 125,000. And so I got 7.456. Now I'm going to have to force this into both of them being dilutive, but I have no idea if they are because I totally made up the numbers. So that's why I shouldn't make up numbers on the fly, but that's okay. So now let's go ahead and let's check to see. So we're going to check each security separately to see if they are dilutive. So, so if we convert all of the preferred stock into common stock, we will not pay preferred dividends, but have more shares of common stock. Okay, so we'll take this concept and we will still have 940,000, but no preferred dividends. And then down here, I'll do 125,000 and an additional 3 shares of stock, 2,000. So 3 shares of stock, 2,000. So an additional 6. So we would do 940 divided by 131. Yes. Okay. Good. I wasn't sure it was going to be. Yes, this is a dilutive security because it made earnings per share go down. Okay. Now, if we convert all of the bonds into common stock, we will not pay interest on the bonds, but have more shares of common stock. So how much is the interest savings? So I equals PRT, and it's 1 million of 6%. And so it is for the whole year, because even if it was semi-annual, it would be like you'd pay it twice a year. So is that 60,000 of interest, and then net of taxes times 0.7. So I think that's what we're gonna do, 1.06 times 0.7. So 42,000 of savings. So then storm. Instead of 940, we're going to add 42 to that because we won't have to pay the interest, which will make the net income go up, but we'll have to pay more taxes. That's why you take it times 0.7. So it looks like we would do 982. And we still have to pay the preferred dividends of 8. And then downstairs, we had 125 before. So go back to basic and compute it. And then we would have 1,000 bonds into 10 shares each. An additional 10,000 shares of stock. So downstairs we'll have 135. So we'll do 982 minus 8 divided by 135. Yes, and so this one also dilutive because it made earnings per share go down. So now combine them. Assume all bonds and all preferred stock is converted into common stock. So no interest on bonds equals savings of the 42,000. What, baby?
Why is it like green out?
I don't know. And then, no, it's not a tornado. Look for funnels. No tornado warning, no alarms going off, everything's good. Extra shares of stock because of both. So if we used to have 125,000 plus an extra 6,000 plus an extra 10,000. So what is that? 141. So here, new net income is 982. So what we'll do is for in total, we will use 982 no preferred dividends, and 141 downstairs. And we should get an answer that's less than 7.17. Yep. So this is the overall answer. Okay. So this example will also take you through that. Yes, diluted combined. So you guys can practice both. Okay, what else? All right, and so on these, I want you to go back into the notes and review. These are for the multiple choice questions, but a lot of the multiple choice questions are really just doing earnings per share or computing the denominator for weighted average number of common shares outstanding. And then, and so the stock options was that percentage, like when we did like 2/5 times 0.9, whatever. So go back and review that as well. So, all right, you guys, I will talk to you soon. Okay. Thank you. Bye-bye.